Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
Wow, that's
Hey,
quite
good
the
morning, Bruce.
applause here.
Absolutely, absolutely. Welcome back for another session of Monday Mortgage Minute.
Yep. I'm really excited about this. And we've been getting a lot of attention. I think we're helping a lot of people, not only other real estate agents, builders, but a lot of consumers out there that are really wanting the truth about what's going on in the industry. So thanks, Tom. Tom McNamara from EXP, one of my all-time favorite realtors, super knowledgeable, great real estate agent, amazing negotiator. And I am not saying that because I'm on your show. I'm saying that because I literally witness him in action. So thanks for being there and thanks for helping my clients.
Absolutely, Bruce. It's been a pleasure doing that over the last few months, and I think we got a couple more under contract recently. So activity's picking up for sure. But we've got three big topics that we've got less than 15 minutes to cover, and I want to make
Let's
sure
do
we
it.
get through all three of them. So the first one is going to be FHA loans just got more affordable. That's super exciting. The second one is VA has reduced the funding fee. So VA works a little differently. We'll get into that and what that means. And then this one's really interesting, Bruce. You're going to have to explain this one to me because Fannie Mae made some pricing adjustments. And, I'm always leery when somebody says adjustments. So that I'm going to need a deep explanation on that. But let's start off with the FHA because I think that's going to affect our affordable housing buyers the most, right?
Yep.
So
So
let's talk about
FHA
the
has two
FHA.
forms of mortgage insurance. They've got upfront mortgage insurance, which is 1.75% that's financed into the mortgage. And then they have a monthly mortgage insurance that on most FHA loans is 0.85%. So the client pays that in their monthly mortgage payment. Well, HUD just came out and they decided they're trying to help more people with affordable housing and maybe a segment of the market, Tom, that's quite frankly underserved and just couldn't qualify for a mortgage anymore because the price of houses going up and interest rates going up. So
Yeah.
they're lowering the monthly MIP or mortgage insurance premium from 0.85 to 0.55. So it's come down about 35 basis or 30 basis points in most cases. Now, that's quite a bit of a savings for people on a monthly basis.
Sure, sure. So what that means, and I see there's a little note there that says that that it's going to drop or save our buyers an average of $800. I'm assuming that's annually, right?
Well,
So
that is an annual amount. That's correct. And that is just what HUD believes the average person. So that would be an average loan amount according to the national statistics of an FHA loan. But if you want to put it in perspective, Tom, if you're looking at a $300,000 loan, it's going to save a buyer about $75 a month. And on a 250 loan, it's going to save them about $63 a month. So it's
sure,
not
sure.
chopped
So
liver.
yeah, no, it sounds pretty impactful. So basically, what I'm hearing is I can buy the same house and pay less money, right? Or if I'm buying based on my payment, right, I can essentially have the same payment for maybe a slightly higher house. So maybe instead of a 250 house, I can buy a 260 house.
Yep, it's definitely going to give you some additional buying power to up it. So, and a client could look at it in either way, just like you said, a little bit more house or a little bit lower payment.
Yeah, that sounds great. That sounds like a win-win for sellers as well, because it just opens up the buying pool a little bit more.
Absolutely. Look at
So this
we need to keep people circulating. We got to help buyers and sellers together.
So I know this doesn't take effect immediately. This is going to start March 20th, right?
Well, it already started because the 20th is in our rear view mirror, or excuse me, is ahead of us. So it will start in about 30 days from now, a little bit less than 30 days from now.
Right.
But what's going to happen is the HUD will start imposing these once they have physically endorsed the transaction. So we're starting to get people ready and keyed up for it right now.
Yeah, perfect, perfect. So we'll start making sure we got people lined up in there, and then obviously, we'll help people be positioned so that they can take advantage of it, right?
That's right.
So
That's right.
fantastic. All right. So topic two, right, is the VA reducing the funding fee. So I'm a veteran myself, and I've bought using a VA loan a couple of times. That funding fee is a pretty big cost up front, right?
It is. It
Yeah.
is.
So tell me about that.
So, VA has decided to also help the veteran. I think personally they could have done a little better than this, but it's still it's okay. It's still better than it was. So for a first time use VA client, somebody that qualifies for a VA loan, the VA funding fee upfront, and this is acquisitioned into the loan. In other words, it's financed into the loan. You don't have to pay for it out of pocket, but
Hmm.
it was 2.3% for the first time use. It's going to 2.15. And
Okay.
then for the subsequent use, in other words, anytime you use your VA after the first time, it was 3.6 and it's now going to be 3.3. So that's about a 30 basis point drop. So between 15 and 30 basis points is not chopped liver. So that makes a difference uh, to a veteran. And I think that we're going in the right direction.
Sure. So that funding fee, if I'm doing good math, right, if for every 100,000, I was paying 2,300 in upfront costs rolled into the loan, but now I'm going to pay 2,150.
That's correct.
Okay,
That
so
is
that's a
correct.
that's a nice savings, but yeah, I agree with you. They definitely they could have done a little bit more.
I
Now,
think they could have done a little better, and I think HUD could have reduced on the other one, they could have reduced the upfront MIP by, 25 to 50 basis points as well.
sure.
So, it used to be years ago only 1%, now it's 1.75%, but they started to get themselves into trouble. So they reassess these things based on market demand and based on default rates.
Yeah, yeah. So it's basically right. So correct me if I'm wrong, but the FHA fees, right? That's kind of like a pool of money that's available for the lenders should a person default on their loan. It's kind of making the lender whole, right? So it's insurance for the lender.
It
Um,
is.
it and I imagine when they have a good bit of cash that they have the ability to lower those premiums and still maintain the service, right? Because we're not getting as many people actually claiming it anymore.
No, the defaults are very down, very are
Yeah,
at all-time lows right now. Matter of fact, they're under 2%.
right.
So, yeah, default rates are very low. Nobody's going to let their house go these days with all the equity
All
that
the
they've
equity.
made in it.
Yeah,
So,
for sure. They've definitely built up a lot of equity. Okay, and one more thing about the VA, we're seeing up here that it takes effect on the 7th of April. Of course, they can't pick the same day, so make everybody's life easy, right? So, but is there a mortgage insurance on a VA loan as well? A
well, the
monthly?
funding fee is the mortgage insurance.
So
So
there's no
each
monthly fee on a
there's no
VA loan.
monthly fee. No,
Okay,
no
so on
monthly
a
fee.
Yeah, so on an FHA, we're going to pay a little bit up front and we're going to pay something every month. And in a VA, we just pay that one chunk up front and then everything else is covered, right?
And of course, if you're a disabled veteran and you have a 10% disability or more, you're exempt from the funding fee entirely anyway.
That's a really good point. I forgot about that one. Another nice thing that at least here in Florida that we do. I'm not sure if you're aware of this or not, Bruce, but if a veteran is 100% disabled, they don't pay property taxes in
That's
the state of
that's true.
Florida. They'll
That's true.
only pay the
They
non-ad
do pay
valorem,
the
which
they
is
do
usually
pay
a
the
few hundred
non-ad
bucks.
valorem, but not the ad valorem. That's
Yeah,
correct.
yeah. It's usually just a few $100. It's your trash and that kind of stuff.
And
So
one other thing, Tom, also that it gets a little bit more in detailed, but the funding fee for VA, if you put money down, drops considerably, or if you go with a 15-year loan versus a 30-year loan, they're considerably dropped as well. And if anybody out there wants to know what that looks like, feel free to give Tom or I a call. We have the
sure.
charts available for you to review that with you.
That's awesome. Awesome. Very good. All right. So we got about 5 minutes left, and we're going to talk about Fannie Mae makes a pricing adjustment. So first of all, who the heck is Fannie Mae, and what does
Well,
that
she's
mean?
that lady that's making cookies, you've never had their chocolate chip cookies before?
No,
Yeah.
no.
She's married to Freddie Mac,
Uh
okay,
huh.
and they make cookies together.
Okay,
So
fair enough.
Fannie Mae and Freddie Mac are who we consider to be conventional or conforming loans. They are the purchasers of mortgages into the secondary market. They are the ones that set the guidelines for all lenders when it comes to delivery for conventional loans. So the rules are the same across the board for any mortgage company in any state if you're getting a conventional loan. So every type of mortgage, whether it's FHA, VA, or conventional for Fannie or Freddie, they make risk level adjustments to mitigate risk. So if they feel like there more defaults, then they tighten up the requirements. If there's less defaults and they're trying to attract more people, they lighten the risk-based pricing on them. So what people may or may not know is that when when the entities like Fannie or Freddie come up with their guidelines are based on risk assessment, which makes sense, right? So
Sure.
what they do is they reanalyze it and they change the algorithms that go into their pricing models and their approval process based on the criteria of the consumer. So for instance, these new level pricing adjustments for really good quality people that are low risk, their pricing will actually get a little bit better. For those that may have a little lower credit scores or putting less money down or buying a condo or a mobile home, which are higher risk, they would go up. So the the cleaner you are, it's gonna help you. The less clean you are, it could hurt you a little bit. So
Okay.
as fate would have it, I ran a loan scenario for a client that was an investor loan. Okay. So investors higher risk than owner occupied investor loan, putting 25% down on a duplex. Higher, that's another higher risk. Multifamily or higher risk than single family. But I ran the pricing and I ran it based on today's pricing adjustments versus after it takes effect on April 7th, and I got a full point improvement for him because he had an 808 credit score. I saved him over $3,000, but we had to go back to the seller to get the date of closing extended a little bit further, but it was
Sure.
a significant change for him. So
So
it
so
can
when
make a
you
difference.
say when you say a full point, you're meaning his upfront mortgage cost, right?
That's
Not
correct.
the
That's based
interest
on the
rate.
discount, not on the interest rate. That's
Not on the
correct.
interest rate. Okay, so you saved him cash at
I
closing.
saved him cash out of his pocket by
Okay.
over $3,000. That's
Hey,
correct. And
money's money, right?
well, money's money, but I'll tell you something. A lot of lenders just didn't go back and say, "Hey, look at," because I got a contract. It says, "Hey, you got to close on this date." That means I have to use these pricing adjustments. I don't have a choice. But if we could renegotiate the closing date, we had a choice, and that benefits everybody. And we always want to look a little deeper to see if we're leaving something on the table for the consumer.
Of course, yeah, absolutely. So that just shows a great level of customer service. I love that. So those things are going to take place after April 7th, and that means the closing needs to be after April 7th. It doesn't mean we have to wait to go under contract, correct?
That is correct.
Okay.
That
So
is correct.
we're almost to the point now where an accepted contract today is almost an April 7th close anyway. So
Yep.
for people that aren't yet under contract, we're right there. You'll be fine. You're not asking for anything out of the ordinary, right?
Absolutely. So maybe next week we can talk about jumbo, maybe some physician loans or something else that we might appeal to a different segment of the market. Maybe we can look in and dive into some more high end products for those that may be listening to this podcast and interview that may help a few other people.
Yeah,
And
that's
Tom,
great, Bruce.
thank you so much for being there. We've got to end the show right now, but I want to thank you and your team for their expertise and helping our clients.
Yeah, awesome. Thanks, Bruce. Appreciate it so much. So, I do want to remind everybody that we have this is on YouTube, right? It's on Facebook and it's also on LinkedIn. But if you could go out and watch it on YouTube, that's our best place. And make sure to like the video and subscribe to our YouTube channel. And we look forward to seeing you next week. Hope you make it a great one.